The median American between the ages of 55 and 64 has saved approximately $134,000 for retirement. That is the Federal Reserve's own number. The Survey of Consumer Finances, published every 3 years, updated most recently in 2022, $134,000. Now, here's what every other finance channel does with that number. They put it in a thumbnail. They put a red arrow pointing down. They say something like, Americans are broke or retirement crisis, and then they spend 12 minutes telling you to save more money. That is not what I'm going to do today. Because the truth is, $134,000 is not a death sentence, and it is not a finish line. It is a data point, and data points are useless without a framework. What I'm going to give you today is that framework. A set of specific savings benchmarks, one for every age from 50 to 65, built on actual math, not motivational slogans. And I'm going to show you why the benchmarks you have seen everywhere else, the ones from Fidelity, from T. Rowe Price, from every generic retirement article you have ever read, are getting a critical variable wrong. Think of this as a staircase, not a smooth ramp, not a single number you either hit or miss. A staircase with 4 distinct floors: age 50, age 55, age 60, and age 65. Each floor has a different savings target. But more importantly, each floor has a different set of financial physics. The strategies that matter at 50 are not the strategies that matter at 60. The risks that threaten you at 55 are not the risks that threaten you at 65. Every time I say floor today, that is what I mean. A specific landing on this staircase where the rules change. And I need to tell you about someone named Raymond. He is 58. He lives in Columbus, Ohio. He is a logistics manager at a distribution company making $91,000 a year. His 401k balance is $312,000 and he thinks he is behind. I'm coming back to Raymond at the end of this video. He has a fifth variable that ties all 4 floors together, and it is probably the same variable you're ignoring right now. Before we get into the floors, quick note. I built a free early retirement calculator that I think is better than the generic ones you find on Fidelity or Bankrate. Here's why. Most retirement calculators ignore fee drag completely. They do not account for sequence of returns risk, and they assume a flat rate of return that has never existed in actual market history. Mine uses BlackRock and Vanguard modeling frameworks and gives you a report based on your actual numbers. I only ask for your email to send the report. I do not store any of your financial data. Link is in the description. Floor 1, age 50. I call this the compounding runway. You think the conventional wisdom here is that you need roughly 6 times your annual salary saved by age 50. That is the Fidelity guideline. If you make $80,000, you should have $480,000 saved. Here's what the data actually shows. The Fidelity benchmark assumes a 4% withdrawal rate, a 67 retirement age, and, this is the part nobody talks about, an average portfolio with no fee optimization, no tax location strategy, and no catch-up contribution acceleration. It assumes you will invest the same way at 50 as you did at 30. The Employee Benefit Research Institute published a study in 2023 showing that Americans who optimize just 2 variables, their expense ratios and their contribution rate, close the gap between where they are and where Fidelity says they should be by an average of 31%. 31%. That is not saving harder. That is saving smarter. So here's the real benchmark for age 50. If you earn the median household income for your age bracket, roughly $85,000, you need between $250,000 and $425,000 saved. The range matters because it depends on 3 things: when you want to retire, what your expenses look like, and whether you have optimized your portfolio allocation. Let me run the math on the low end. $250,000 invested at an average annual return of 9.65%, which is the S&P 500 average from 1957 through 2023, grows to approximately $1.1 million by age 65. Now take that same $250,000, but use the average net return after typical fund fees, 6.81% instead of 9.65%. You get approximately $730,000. The gap is $370,000, just from fees. That is not subtle. That is a second house. I want to introduce you to Sandra. She is 51, a project coordinator at a health system in Tampa, making $78,000 a year. Her 401k is sitting at $189,000. She has been contributing 6% with a 3% employer match. She has never looked at her expense ratios. Sandra is not in crisis. Sandra is on the runway, but her plane is burning fuel it does not need to burn. I checked her 401k fund options. She is in a target date fund with a blended expense ratio of 1.04%. The same allocation in index funds through her plan has an expense ratio of 0.06%. That difference, 0.98%, on her balance over the next 14 years to age 65, costs her approximately $47,000. $47,000. For a phone call to her HR department, Sandra is going to come back later. She makes a second discovery that changes her trajectory completely. Floor 2, age 55. I call this the optimization window, and it is the most misunderstood age in retirement planning. You think the problem at 55 is that you have not saved enough. Every retirement article you have ever read frames it that way. Are you behind? Here is how to catch up. The implication is always that you failed, that you spent too much, that you should feel guilty. Here's what the data shows. The problem at 55 is almost never the contribution amount. It is the allocation efficiency. Michael Kitces, one of the most respected financial planning researchers in the country, published an analysis showing that for Americans between 50 and 60, the single largest drag on portfolio growth is not undersaving. It is overpaying, a combination of high expense ratios, cash drag from money sitting in money market funds inside their 401k, and asset allocation drift, meaning their portfolio has shifted over time but they have never rebalanced. The benchmark for age 55 is between $450,000 and $625,000. But here's the part that changes the math. At age 55, the IRS lets you contribute an additional $7,500 per year to your 401k as a catch-up contribution. That is on top of the $23,500 base limit for 2025. That means at 55, you can shelter $31,000 per year in your 401k alone. If your employer matches, you could be putting away $35,000 to $40,000 a year in tax-advantaged accounts. Let me show you what that does. If you are 55 with $450,000 and you max out the catch-up contributions for 10 years at an 8% average return, you end up with approximately $1.38 million by 65. Without the catch-up contributions, just the base limit, you get approximately $1.12 million. That extra $7,500 per year over 10 years with compounding creates a $260,000 difference. $260,000 for checking a box on a form. By the way, hit subscribe if you are finding this useful. I do not run ads in these videos, and YouTube's algorithm decides whether to show you my content based almost entirely on whether you have subscribed. I make these videos to build the channel, and subscriptions are the actual mechanism that makes that work. Now let me tell you about the fee drag, because this is where Floor 2 gets really interesting. Dalbar, the financial research firm, publishes an annual study called the Quantitative Analysis of Investor Behavior. Their 2023 report found that the average equity fund investor earned 6.81% annually over the previous 20 years. The S&P 500 returned 9.65% over the same period. That gap, 2.84% per year, is not all fees. Some of it is behavioral, selling during downturns, chasing hot funds. But Dalbar estimates that roughly 1.2 to 1.5% of that gap is direct cost drag, expense ratios, advisory fees, transaction costs inside mutual funds that never show up on your statement. On a $450,000 portfolio over 10 years, a 1.2% annual fee drag costs you approximately $81,000. I want you to sit with that number, $81,000. You did not write a check for it. Nobody sent you a bill. It just quietly disappeared from your future. This is what I mean by the optimization window. At 55, you have enough money for fees to matter and enough time for compounding to amplify the difference. This window between 55 and 60 is where portfolio hygiene has the highest return on effort of any financial decision you will ever make. Remember Sandra from Tampa? She is 53 now in this scenario. Her balance has grown from 189,000 to 218,000. But she still has not made that phone call to HR. She is still in the target date fund at 1.04%. Her colleague mentioned index funds at a lunch meeting. Sandra went home, opened her 401k statement, and for the first time, actually looked at the fund fact sheets. She found three things. 1. Her expense ratio was 1.04%. 2. 11% of her fund was sitting in a money market position, earning almost nothing. And 3. The fund had not been rebalanced in over 4 years, meaning her allocation had drifted from the target by almost 9 percentage points. Sandra made 3 changes. She switched to a low-cost index fund blend at 0.06%. She eliminated the cash drag, and she set up automatic quarterly rebalancing. The projected impact over the next 12 years to age 65, an additional $93,000 in her portfolio. $93,000? Not from saving more, from paying attention. Floor 3. Age 60. I call this the decision corridor because between 60 and 65, you will make more consequential financial decisions than you made in the entire previous decade. The benchmark for age 60 is between $650,000 and $900,000. And I know, whoa, that is a wide range. The range is wide because at 60 the variables multiply. Social Security claiming age matters now. Healthcare costs before Medicare eligibility matter now. Whether you plan to work part-time between 62 and 67 matters now. Each of those decisions shifts your number by tens of thousands of dollars. You think the problem at 60 is that you are running out of time, that if you are behind on savings, it is too late to catch up. Here's what the data shows. Wade Pfau, a professor at the American College of Financial Services who has spent 2 decades studying retirement income, found that the single most impactful decision for Americans between 60 and 65 is not how much they save in those final years. It is how they sequence their income sources in the first 5 years of retirement. What does that mean? It means the order in which you draw from your 401k, your Roth, your Social Security, and your taxable accounts in those first years determines whether your money lasts 22 years or 34 years. Let me run 2 scenarios for someone with $650,000 at age 60. Scenario 1. They retire at 62, claim Social Security immediately, and draw from their 401k to cover the gap. Their Social Security benefit at 62 is roughly $1,800 per month, $21,600 per year. They need about $55,000 a year in total income. So they pull $33,400 from their 401k annually. At that withdrawal rate, with a conservative 6% return, their 401k runs out at age 81. Scenario 2. Same person, same $650,000. But they delay Social Security to 67, work part-time from 62 to 64 earning $30,000 a year, and make smaller 401k withdrawals of $25,000 per year during those bridge years. At 67, their Social Security benefit is roughly $2,800 per month, $33,600 per year. Their 401k withdrawals drop to $21,400 per year. Under Scenario 2, their 401k lasts until age 91. That is a 10-year difference. 10 additional years of solvency from the same pile of money, not from saving more, from sequencing differently. The math here is not subtle. Let me tell you about Gerald. He is 61, a senior electrician at a manufacturing plant in Pittsburgh, making $94,000 a year. His 401k is at $587,000, and his wife Carol is 59 with her own 401k at $212,000. Together, they have about $800,000. Gerald's plan was to retire at 62 and claim Social Security right away. Carol would keep working until 65, and then they would both draw down. Their financial advisor, a nice person by the way, not a villain in this story, had never modeled the income sequencing alternative. Gerald is going to reconsider. I will show you what happens when he does. There is another decision in the corridor that almost nobody talks about on YouTube, and it involves Roth conversions. Between the time you retire and the time you turn 73, which is the new age for required minimum distributions, there is a window where your taxable income drops. You are no longer earning a salary, but you have not yet been forced to take distributions from your traditional 401k or IRA. During that window, you can convert portions of your traditional 401k to a Roth IRA, paying income tax at a lower bracket. Now, and then letting that money grow and withdraw completely tax-free for the rest of your life. Let me give you a real number. If Gerald retires at 63 and converts $50,000 per year from his traditional 401k to a Roth over 4 years, $200,000 total, he pays roughly $24,000 in taxes on those conversions at the 12% bracket. But that $200,000 in the Roth, growing at 8% for 20 years, becomes approximately $932,000. Tax-free, not tax-deferred. Tax-free. The $24,000 he paid in taxes generated $932,000 of tax-free income. That is a return on tax investment of nearly 39 to 1, and I am not making up this math. This is the framework that financial planner Michael Kitces has written about extensively. The golden window between retirement and RMDs is, dollar for dollar, one of the highest value financial maneuvers available to Americans. The reason you have not heard about it is simple. It does not generate fees for anyone. No fund manager profits from you converting. No advisor gets a commission on the conversion, so nobody advertises it. Floor 4. Age 65. I call this the launch pad, and I chose that word deliberately. Most people think of 65 as the finish line. You hit 65, you retire, you are done. But 65 is not the end of your financial life. It is, if you have done the work on the first 3 floors, the beginning of a new one. The benchmark for age 65 is between $850,000 and $1.2 million. And before you close this video, because that number feels impossible, let me tell you something. That range already accounts for Social Security income. You are not replacing your entire salary from savings. You are supplementing Social Security with portfolio withdrawals. If your combined Social Security benefit is $44,000 per year and you need $70,000 in annual retirement income, your portfolio only needs to generate $26,000 per year at a 4% withdrawal rate, which is the rate William Bengen established in his 1994 research and which has been validated by the Trinity study and subsequent analysis. $26,000 per year requires $650,000 in invested assets. But here is the reversal. You think the 4% rule is the answer. Every finance channel quotes it. Every retirement calculator uses it. William Bengen himself has said publicly that 4% was designed as a worst-case floor, not a typical spending rate. The actual safe withdrawal rate for a diversified portfolio over a 30-year retirement, based on Bengen's updated research, is closer to 4.5%. And for people who are willing to be slightly flexible, reducing spending by 5 to 10% during down markets, Kitces has shown that the safe rate can exceed 5%. That difference between 4% and 5% on $850,000 is $42,500 per year versus $34,000 per year. That is an additional $8,500 per year in spending money. Over 30 years, that is $255,000. $255,000. Because you understood that 4% is a floor, not a ceiling. Now let me tell you what happened to Gerald and Carol. Gerald did not retire at 62. After seeing the income sequencing math, he worked until 64 and did part-time consulting for 2 more years. Carol worked until 62. Gerald delayed his Social Security to 67. During the gap years, they converted $175,000 from Gerald's 401k to a Roth at the 12% bracket. At 67, their combined Social Security was $52,000 per year. Their combined portfolio, 401k plus Roth, was $1.1 million. Their required annual withdrawal dropped to $18,000, giving them a withdrawal rate of just 1.6%. Gerald told his financial advisor, the same nice person from before, what he had done. The advisor looked at the numbers and said, I wish more of my clients understood this. The system is not complicated, it is just not advertised. Remember Raymond, the logistics manager in Columbus? With $312,000 at age 58. I told you I would come back to him. Raymond did the math. He ran the numbers on all 4 floors. He looked at his expense ratios. They were low, actually, at 0.12%. He was already in index funds. His contribution rate was 14% with a 4% match. He had done the catch-up contribution since 55. On paper, Raymond was doing everything right. By 65, his projection showed approximately $890,000. Combined with Social Security, he could retire comfortably. The math cleared. The math actually cleared at 62. He could have made it work 3 years earlier with a modest bridge strategy, but Raymond did not retire at 62, or 63, or 64. His balance is now $347,000 at 58 and growing. Here's the fifth variable, the one that ties all 4 floors together, and it has nothing to do with money. It is the gap between when the math clears and when the person actually retires. Kahneman and Tversky's prospect theory, published in 1979, established that humans feel the pain of a potential loss roughly twice as intensely as they feel the pleasure of an equivalent gain. When the math says you can retire, your brain does not say congratulations. Your brain says, but what if the market drops? Or, but what if I need long-term care? Or, but what if something happens to Janet? Janet is Raymond's wife. She was diagnosed with early-stage Parkinson's last year. Raymond told his brother that the reason he had not retired was the money. His brother, who is a CPA, looked at Raymond's numbers and said, Ray, the money has been fine for 2 years. What are you actually afraid of? Raymond spent 412 days working a job he was finished with because the math said yes, but his brain said, wait, this is the variable that no spreadsheet captures. No savings benchmark includes it. No financial advisor is trained to address it. The gap between financial readiness and emotional readiness is, for most Americans over 55, the single largest determinant of whether they experience their retirement as freedom or as a series of years they cannot get back. Raymond is retiring in June. Janet asked him to. Not because of the money, because of the time. The money was ready at 62. Raymond was ready at 58. Those are not the same thing. 3 things you do this week, not some abstract future point. This week. Number 1, calculate your actual savings rate right now, not the percentage you set 5 years ago and forgot about. Log into your 401k portal, add up your contribution plus your employer match, and divide by your gross income. If that number is below 15% and you are over 50, increase it by at least 2 percentage points this week. If you're over 55, you should be maxing out the catch-up contribution. The form takes 4 minutes. Number 2, look up the expense ratio on every fund you currently own. If you do not know how, search for the fund name plus fact sheet, and it is on the first page. If any fund has an expense ratio above 0.2%, find the index fund equivalent in your plan. Sandra's phone call took 11 minutes. It is worth $47,000. Number 3, model your retirement income sequence. Take your current savings, project it forward to your target retirement age at 7%, and then map out your first 5 years of retirement income. Social Security, portfolio withdrawals, any pensions, any part-time work. Write down the order you plan to draw from each source. If you have never done this, and most people have not, you are flying blind in the decision corridor. The free calculator I mentioned at the top does exactly this. Link is in the description. The staircase is not about panic. It is not about guilt. It is about physics, financial physics. Each floor has its own gravity, its own leverage points, and its own set of moves that create disproportionate results. At 50, you optimize the runway. At 55, you optimize the portfolio. At 60, you optimize the sequence. At 65, you launch. The number you need saved is not one number. It is 4 numbers, calibrated to the specific physics of each floor. Cure your license to chill. Fix the wealth drain today. The math is waiting for you. The question is whether you're waiting for the math.